Hey everyone, welcome back to Corporate Decoder, the place where we shine a spotlight on the behind the scenes of big business. Today we are diving into the 21Shares Dogecoin ETF's latest 10Q report. Think of it as a peek under the hood of a fund trying to ride the wave of cryptocurrency excitement. Curious to see if it is smooth sailing or a bumpy ride? Stick around. And before we get started, if you love getting clear, no-nonsense insights from these financial filings, make sure you are subscribed. We also have a Discord community linked in the description below where we break down more corporate secrets. Alright, let's get straight into it. This report covers the quarterly period ending the 31st of December 2025 for the 21Shares Dogecoin ETF, or TDOG as it is known on the stock market. Essentially, this ETF is designed to track the price of Dogecoin, that is the digital coin that started as a meme. A lot of firms are trying to tap into the crypto craze, and this ETF is one of them. Now, this document is a Form 10Q, which is a quarterly report that companies file with the US Securities and Exchange Commission, or SEC. It gives investors a look at how the company is doing financially and operationally during that specific 3-month stretch. It is not an annual report, so it is more of a snapshot, but still very important. Interestingly, they're a non-accelerated filer and a smaller reporting company, which means they have fewer disclosure requirements compared to larger, more established companies. This is pretty common for newer or smaller entities. The report we're looking at is for the period ending the 31st of December 2025. This tells us the financial picture they're presenting is from the end of last year. This little tidbit tells us how many shares of the ETF were floating around out there at a specific point in time. It is a way to gauge the size of the fund. This section, called Statement Regarding Forward-Looking Statements, is basically a warning label. Companies use it to say that some of the things they're talking about, especially about the future, are just predictions. They're not guarantees, and the actual results could be very different. It is all about managing expectations and protecting themselves legally. They mention that things like movements in the digital asset markets, the ETF's operations, or the sponsor's plans are all forward-looking. They also proudly announce they are an emerging growth company. This designation comes from a law called the Jobs Act, and it means they get to take advantage of some relaxed rules. For instance, they might not have to have their auditors check their internal financial controls as rigorously as bigger companies. They can also delay adopting new accounting rules, which can give them more time to get ready. They'll stop being an emerging growth company once they hit certain milestones, like reaching $1 billion in annual revenue or becoming a large accelerated filer. Now, let's navigate to the heart of the financial disclosures. This document lays out a clear table of contents, guiding us through the financial statements, management's discussion, and other important information. Here we find the statements of assets and liabilities. This is where we see what the ETF actually owns and owes at a specific point in time. Think of it like a balance sheet for the fund. We can compare two dates here, the 31st of December 2025 and the 30th of September 2025. This lets us see how things changed over the quarter. Looking at total assets, we see a stark number. For the 31st of December 2025, the total assets are listed as 0. That is right. 0 then, if we look back to the 30th of September 2025, the total assets were just $100. This is a very small amount, really telling us the fund was in its infancy, barely started. And total liabilities are also 0 for both periods. This means the fund didn't owe anyone anything. So when you subtract liabilities from assets, we get net assets. On the 31st of December 2025, the net assets are 0. On the 30th of September 2025, they were $100. This aligns with the asset numbers. This line, shares issued and outstanding, shows 2 shares as of the 30th of September 2025 and 0 as of the 31st of December 2025. This indicates a redemption of shares happened, and the net asset value per S-share was $50 on the 30th of September 2025 and 0 on the 31st of December 2025, which makes sense if all shares were redeemed. These numbers really highlight that the fund was just starting out, barely off the ground, and then saw its initial shares redeemed. Next up is the statement of changes in net assets. This tells the story of how the net assets changed over this 3-month period. It shows that at the beginning of the period, the 31st of December 2025, the net assets were $100. There were no new contributions from shares being issued, but there were distributions for shares redeemed, totaling $100. This perfectly explains why the net assets went from 100 to 0. Those initial shares were bought and then redeemed. And you can see here, 2 shares were redeemed. Now, let's dive into the notes to financial statements. These notes provide crucial context and details that aren't immediately obvious from the main financial statements. The first note explains the organization. The 21Shares Dogecoin ETF, or the trust as they call it, was actually formed on the 1st of April 2025. It was originally called Durapentium Trust 10, but then changed its name to 21Shares Dogecoin ETF. It operates as a Maryland statutory trust. Wilmington Trust is the trustee and 21Shares use is the sponsor which manages and controls the trust. They also mention custodians like Coinbase, Anchorage, and BitGo that hold the actual Dogecoin. This section really sets the stage, showing the entities involved and the basic structure of the fund. This is important. It confirms that the ETF issues shares, which are units that represent a piece of the fund's assets. These shares trade on the Nasdaq stock market under the ticker symbol TODOG. Their main goal is simple: seek to track the performance of Dogecoin. That means they want the ETF's value to go up and down pretty much in sync with Dogecoin's price. They use the CF Dogecoin dollar settlement price index as their benchmark. This is where we see those initial numbers coming from. On the 17th of September 2025, the sponsor itself, as the seed capital investor, bought 2 shares for $50 each, totaling $100. This was the initial seed money to get the fund going. This is a key takeaway for this period. The trust had no real operations beyond that initial seed transaction. It was basically dormant until it launched properly later. This section details the significant accounting policies, essentially how they record and report their financial activities. They follow us generally accepted accounting principles, or GAAP. They mention that for accounting purposes, the trust is treated as an investment company, but it is not registered as one under the Investment Company Act of 1940. This is a technical distinction, but it shapes how they account for their assets, particularly the Dogecoin. This is critical for any crypto-related fund. Investment valuation explains how they determine the worth of the Dogecoin they hold. They use fair value, which generally means what they could sell it for in an orderly market. They describe a hierarchy of how they determine this value, focusing on observable market data when possible. Under federal income taxes, they explain that they expect to be treated as a grantor trust. This means the trust itself won't pay taxes, but the profits and losses will pass through directly to the shareholders. So if the trust sells Dogecoin to pay fees, that is a taxable event for the shareholders. Segment reporting tells us the trust operates in one segment. This isn't surprising as it is a single ETF. The chief operating decision maker, which is the CEO of the sponsor, monitors its performance. Here we get into trust expenses. The main fee is the sponsor fee, which is 0.50% of the trust's net asset value. This fee compensates the sponsor for their services. The sponsor also covers a bunch of other operating expenses like fees for marketing, administration, custodians, and legal costs, but they won't cover extraordinary expenses like litigation costs. The sponsor also shouldered the initial costs of setting up the fund. This section is about how new shares are created and existing ones are redeemed. It is a bit technical, involving authorized participants who deal in large blocks called baskets. They can create shares by giving cash or Dogecoin to the trust, and redeem shares by getting cash or Dogecoin back. This directly references the redemption we saw earlier. The sponsor redeemed those initial 2 shares for $100 on the 15th of October 2025. This activity explains the zero assets and shares outstanding at the end of the quarter. Related Parties identifies the sponsor as a related party. It also notes that as of the 30th of September 2025, the sponsor owned 2 shares, but by the 31st of December 2025, they owned 0 shares. This again points to that redemption activity. This is a very important risk factor for an ETF like this. Concentration risk highlights that the trust investment is focused solely on Dogecoin. This means if Dogecoin's value plummets, the ETF's value will suffer directly with no other investments to cushion the blow. It is a high-stakes, single asset bet. Indemnification is about who is protected from liability. Basically, the sponsor isn't liable for acting in good faith, but they can be held responsible for gross negligence or bad faith. The trust, on the other hand, indemnifies the sponsor and the trustee against losses incurred while performing their duties, as long as they acted properly. Subsequent events covers important things that happened after the reporting period, but before the report was issued. This is where we see significant new activity. This is a huge update. On the 21st of January 2026, the sponsor, acting as the seed capital investor, bought a massive 60,000 shares at $25 each. This means the fund raised about $1.5 million in capital shortly after the reporting period ended. This is the real start of operations. And even more importantly, the very next day, the 22nd of January 2026, the trust officially started its operations and its shares began trading on the Nasdaq. This is when the ETF truly became available to the public. Moving on to management's discussion and analysis, or MD&A, this is where the company's management explains the financial results in their own words, giving context to the numbers. They reiterate the trust organization, its goal to track Dogecoin, and its structure. They mention the key players like the sponsor, trustee, and custodians. This reinforces that shares are created and redeemed in large blocks, not one by one, which is typical for ETFs. They explain how the net asset value, or NAV, is calculated. It is the total value of the assets minus liabilities. This NAV per S-share is what determines the price of each share of the ETF. They differentiate between the NAV calculated using the benchmark index and the NAV based on what they consider the principal market for Dogecoin. Under critical accounting estimates, they re-emphasize that their financial statements rely on estimates and assumptions. They state that for this period, there weren't any material estimates with significant uncertainty that would likely impact the financial condition. Liquidity and Capital Resources discusses the fund's ability to meet its financial obligations. For this period, with almost no assets or operations, it is pretty straightforward. Their main ongoing expense will be the sponsor fee. The sponsor covers most operational costs, ensuring the fund has the cash flow it needs, or at least that the sponsor is taking on that burden. Because they are a smaller reporting company, they are not required to provide detailed disclosures about market risk. This means less transparency on how they manage risks related to things like price fluctuations in Dogecoin or interest rates. Disclosure Controls and Procedures confirms that the officers from the sponsor have evaluated the effectiveness of the trust controls. They concluded that the information required by the SEC is being properly recorded, processed, and reported in a timely manner. They also state there have been no changes in their internal control over financial reporting that would materially affect it. Now we move to part 2, which covers other important information. Under legal proceedings, they state that as of the 31st of December 2025, there were no material legal proceedings against the trust, nor were any threatened. This is good news for a new fund. Risk factors refers back to their registration statement. They don't list any new material changes to the risks already disclosed. This means all the risks they've already warned investors about, like the volatility of Dogecoin and the general risks of investing in digital assets, still apply. This section talks about share sales. It mentions the initial sale of 2 shares on the 17th of September 2025 to the sponsor for $100. This reiterates that the shares TODOG started trading on the Nasdaq on the 22nd of January 2026. That is the public launch date. Finally, Exhibits lists all the supporting documents filed with the report, like the trust agreement and certifications from the principal officers. This is mostly for compliance and provides access to foundational documents. The report is signed by Russell Barlow, the Chief Executive Officer of the sponsor, and Duncan Moore, who holds multiple important financial roles. This signifies their approval and responsibility for the information presented. So, what is the verdict on this filing, this 10? Q really paints a picture of a fund in its absolute infancy. For most of the period we're looking at, the 21Shares Dogecoin ETF had minimal assets, barely $100, and only 2 shares outstanding, which were quickly redeemed. It was essentially a placeholder awaiting its full launch. The subsequent events section is where the real action happens, detailing the significant capital infusion of $1.5 million and the public listing on the 22nd of January 2026. This tells us the period covered by this report is pre-operation for the general public. The biggest risk, as highlighted, is the concentration in Dogecoin itself. If Dogecoin takes a nosedive, this ETF will follow suit with no diversification to soften the blow. While the sponsor seems to be covering most initial costs, investors need to be acutely aware that they are betting entirely on the performance of a single, highly volatile digital asset. The fund's direction is clear: track Dogecoin. Its strength lies in its potential to capture Dogecoin's upside, but its weakness is undeniable in its complete lack of diversification and the inherent volatility of its underlying asset. Alright, that is our breakdown of the 21Shares Dogecoin ETF's latest filing. What is your take on these numbers and what they signal for the company's future, especially considering the recent launch? Drop your thoughts in the comments below. If this analysis was valuable, hitting that like button really helps us out, and subscribe for more deep dives into the corporate world. Don't forget to check out the Discord link in the description for more exclusive content and discussions. Thanks for watching, and we'll see you next time.